Good afternoon, this is Christian Thwaites from Brown Janikowski on Tuesday, December the 8th. I'm going to spend a little bit more time this time talking about emerging markets, what's happened in 2015 and what we expect for 2016. Take a look at this slide. You can see that by any measure, investing in emerging markets for the last year and for the last few years has been a very torrid affair. Every time this slope goes up, it means that emerging markets have outperformed the S&P 500. And you can see from about 2011, the last 4 years, that has been a downward slope, which essentially means that emerging markets have underperformed the S&P 500 and by quite a considerable margin this year, by up to 13%. So let's have a look at what's been going on in 2015 and more importantly what we think is going to be happening in 2016. First of all, for 2015, there are really three major stories which I think are dominating the emerging market story. First of all, China. China is undergoing a very difficult transition from an investment-led economy to a consumer-led economy. Investment-led economies are quite able to be centrally planned. Consumer-led economies, much less so. There's been huge overinvestment in China in the last decade, and now that transition of the economy is quite painful. State-owned companies, which are in the forefront of investment-led companies, have less investment-led economic growth, have traditionally been supported by the state, have had very low returns on capital and equity, and in fact have destroyed a lot of shareholder equity. They're now going into a transition of a greater accountability. The other major item that's happened in China is the strength of the currency against not so much the dollar, but against its major trading partners, such as Hong Kong, Taiwan, and very importantly Japan and South Korea. And this has actually hurt some of the Chinese major industries. And in the summer we saw a gross mismanagement of the stock market by the authorities, attempting to get people to buy and then putting a lot of dampers and clamps down on people able to sell stock. So that effectively manipulated the market and investors lost confidence. Second main area in emerging markets in 2015 was commodities, and this was whether it's oil or energy-related commodities, or the major metals such as copper, zinc, iron ore, coal. All of these commodities suffered terribly in 2015, primarily from a global slowdown. And a lot of emerging markets, especially outside of China, of course, are very dependent on exports of basic commodities. The two biggest stories here, of course, are Russia, which has political risk and is extremely dependent on energy exports, and Brazil, with also its energy exports and then its related economies, which are more in the hard commodity area. But both these countries, in addition to their commodity problems and the raw prices they were able to get, of course, had two large political overhangs. And the final story around commodities, of course, has been excess supply over the last few years as things like shale gas and other new mining techniques have come on stream, which means that a lot of supply has been seeking an ever smaller pool of demand. The third major area in 2015 for emerging markets was the timing of the rate hike and the rate uncertainty. There was a lot of thought that the Fed was going to raise rates in October. It now looks like they're going to do it in December. But either way, this affected a lot of emerging market, both economies, sovereign borrowers, as well as state and large company borrowers, who are either borrowing in their local currency, and we're going to see rates go up in defense of the dollar, or in fact who'd had large dollar-denominated debt, which was going to become more expensive for them to service. So those sort of double hits of higher servicing costs puts a lot of downdraft on emerging markets. So that really explains the 2015 story and why the underperforming was so pronounced. But let's look at 2016 and four areas that we're looking to be sort of major catalysts and we think improvements to the emerging market story going into the new year. First of all, India. India has really shone brightly in the emerging market universe. It's quite a large part of the emerging market, and it's gotten quite expensive because people have really invested there as opposed to the other major emerging markets. The story there is that India is a local consumption story. It's about a middle class getting more affluent, spending more on consumer goods, and in combination with some very major structural reforms, which we think will be very important to loosen up the economy and let sort of entrepreneurial and capitalism flourish. We've also got a central bank there, which is, unlike most emerging market central banks, is headed up by a very distinguished World Bank economist, and they are determined to lower inflation, and so combination with a disciplined monetary policy and structural reforms, I think India should be a very interesting place going on to 2016. The second major area we're looking at is how the markets cope with the rate rise. There will be some credit events, probably quite pronounced ones and quite headline-grabbing ones. But we think once this sort of major shortfall, major concern is over, that will allow credit to rebuild, spreads to begin to compress, having widened out a bit, and also for people to be less concerned about the event because it will have happened. And we think a lot of the emerging market borrowers will be able to manage it, albeit with a difficult start. The third area we're looking at is really what we call New China. This is about moving into the domestic market. It's industries like consumer, tech, healthcare, retail. It's about freeing up capitalism, which has been quite often suffocated by large state-owned enterprises and sort of centrally directed government policies. So we think that will be important, and there'll be a lot of upside as we sort of look down to small, less large, giant market cap entities and more companies which will be able to take advantage of those growth. There's also a possibility of some fiscal stimulus coming from the Chinese authorities, which would certainly add to the betterment of the story. And the fourth main area that we're looking at is Brazil. Brazil's had a very difficult time. The political landscape has unraveled. There's possibly an impeachment process going on. So the political risk is by no means over, but we think it'll be rectified one way or another in 2016. At the same time, there is an undercurrent to continue to improve structural reforms. Structural reforms have been going on for some time, but not necessarily in the areas which benefit private industry. But we think that will begin to change in 2016. And we'll be looking at domestic companies where they'll be trying to improve the productivity of their underlying industries. So Brazil is certainly one which has captured the headlines for the wrong reason in 2015, but we hopefully will be for the right reasons in 2016. So let's put all this together. We don't think that there's going to be a major hard landing in China. Certainly bad news, but not the hard landing that we saw in the US in 2008 or 9. We think the economies and the markets will slowly adjust to the rate increases. Now they're sort of a little bit more out in the market, and we'll see how they adjust to both the likelihood of a stronger dollar and increased borrowing rates. And then the third big story is reforms. Reforms that continue to happen. They tend not to always hit the headlines, but they are slowly making these economies very attractive for domestic competitors and domestic industries. And we think that will eventually close the gap and make emerging markets an interesting investment place for the next 2 to 3 years. Thank you very much, and please call us or email us if you have any questions.